2022 proved to be a challenging year for stocks as both the S&P 500 and Nasdaq faced their worst annual performances in over a decade. However, don't lose hope just yet. There are intriguing indications that the very same stocks that took a hit in 2022 might be gearing up for a remarkable comeback in 2023. Welcome everyone to our channel. In today's episode, we have some exciting insights to share with you regarding the potential boom of tech stocks in the upcoming year. We'll delve into the reasons why we believe tech stocks are poised for success and explore a specific sector within the tech industry that holds immense upside for the year ahead. So don't miss out on this exciting episode. The potential for a tech stock boom in 2023 is too compelling to ignore. So get ready to seize the upside and embark on a thrilling journey towards investment success. Let's dive in. There have been quite a few skeptics out there doubting the US stock market. They've been looking for any sort of validation to support their pessimistic views. Despite all the doom and gloom and people preparing for an economic catastrophe, the Nasdaq 100 has actually made a remarkable 23% gain this year. Can you believe it? And it's now getting closer to its highest point in the past 52 weeks. Here, we will share a few reasons we believe tech stocks will soar in 2023. Number 1. A positive year typically follows a negative year. It is commonly said that where there is crisis, there are also opportunities. This statement holds significant truth for the tech stocks as demonstrated by the following examples. In 1981, the Nasdaq experienced a decline of 3%. However, the subsequent year saw a remarkable return of 19%. Similarly, in 1984, the Nasdaq dropped by 11%, only to bounce back with a substantial 32% increase the following year. In the year 1987, we witnessed a 5% decrease in the Nasdaq, but it swiftly recovered, showing a 15% growth in the subsequent year. And in 1990, the Nasdaq shed 18% of its value, yet in the following year, it soared impressively by 57%. During the financial crisis of 2008, the Nasdaq faced a significant decline of 41%. However, it rebounded strongly the next year, jumping by 44%. And in 2011, the Nasdaq experienced a minor decline of only 2%, but it quickly recovered, delivering a substantial 16% growth the following year. In fact, since 1970, whenever technology stocks have had a difficult year, they have almost always rebounded vigorously in the subsequent year. There were only two exceptions to this trend, the 1970s and the early 2000s. The early 2000s marked the bursting of the tech bubble when technology stocks were trading at significantly inflated earnings multiples exceeding 30x. However, today in 2023, the majority of stocks within the Nasdaq are trading below 25x earnings. As for the 1970s, tech stocks experienced consecutive declines due to rapidly rising inflation. And today, it is relatively safe to say that after the Federal Reserve's aggressive interest rate hikes, inflation has peaked. This brings us to the second reason we will be discussing. Number 2. Tech stocks experience massive rallies after inflation peaks. The decline of tech stocks in 2022 was primarily attributed to rising inflation and subsequent interest rate increases. However, it is widely recognized that inflation has reached its peak and is currently trending downward. Throughout the past 50 years, the US economy has encountered three hyperinflationary periods: the mid-1970s, the early 1980s, and the early 1990s. On each occasion, following the peak of inflation in the cycle, tech stocks experienced significant growth over the subsequent 12 months. For instance, when inflation peaked in November of 1974, tech stocks rose by approximately 25% within the following year. Similarly, when inflation reached its peak in March of 1980, tech stocks surged by around 70% within the subsequent 12 months. Likewise, when inflation peaked in October 1990, tech stocks experienced a substantial increase of approximately 60% within the following 12 months. This pattern clearly demonstrates that when inflation reaches its peak, tech stocks tend to soar. Therefore, it is reasonable to expect a similar outcome in 2023. Number 3. Strong profit margins will support the tech rebound in 2023. Do you remember the layoffs that occurred in the tech industry earlier this year? Well, some may interpret this as negative news for tech stocks. However, it is important to note that when a company announces layoffs or cost-cutting measures, its stock price often rises in response. It may sound counterintuitive, but within the tech industry, layoff announcements are generally viewed as positive news because they signify reduced expenses and higher profit margins. The reality is that tech companies hired excessively during the pandemic, incurring additional operating expenses that did not necessarily generate additional revenue. As a result, expenses outpaced revenues, leading to shrinking profit margins. Now, tech companies are rectifying this situation by downsizing their workforce, which they brought on during the pandemic but did not truly require. Consequently, revenues will remain unaffected while expenses will decrease. This in turn will lead to a meaningful expansion of profit margins. This is significant because the trajectory of tech stocks often follows the direction of profit margins. Let's not brush off the possibility of facing some tough times ahead. Picture this. The strong economic and market performance we're enjoying right now might actually give the Federal Reserve the confidence to hike up interest rates even more to tackle inflation. The latest Consumer Price Index report suggests that core inflation remains stubbornly high but steady. And Fed officials have already come out to say that they think there is still room for hiking even after a temporary pause in June. If policymakers end up jacking up rates and keeping them at elevated levels for a long time, it could eventually hurt the economy. However, we might not see the full impact of that right away. People who are overly fixated on doom and gloom right now might be missing the rally that is taking place in the market. If you're looking to ride the wave of the current tech stock rally, especially in the exciting world of artificial intelligence, you are not alone. Many institutional investors have been doing the exact same thing, and they are getting some handsome returns. Franklin Templeton's FTGF Martin Curie Global Long-Term Unconstrained Fund is just one example. This fund has been outperforming 96% of its peers in 2023 with a remarkable return of around 15%. Compared to its benchmark, the MSCI All Country World Index, which reported a gain of 8% during the same period. The fund's portfolio includes some heavy hitters in the tech industry. One of its notable holdings is Nvidia, a company riding high on the wave of increased demand for artificial intelligence. The fund also allocates investments in Dutch semiconductor firm ASML Holding NV and tech giant Microsoft Corporation. These companies have been driving growth and capturing opportunities in their respective fields. Interestingly though, the Franklin Templeton's fund has made some conscious choices when it comes to certain tech giants. It opted to steer clear of investing in Apple, Alphabet, the parent company of Google, Meta, formerly Facebook, and Netflix. Why, you may ask? Well, according to the fund's manager, these companies have a more direct exposure to the consumer market and don't score well on the fund's fundamental metric scale. In a recent discussion, the fund manager shared his thoughts on the technology sector. He believes that with the Federal Reserve putting a halt to interest rate hikes, the tech industry continues to be an attractive investment option. However, he doesn't foresee any rate cuts coming our way. Therefore, the fund manager emphasizes the importance of taking a more targeted approach within the sector, rather than simply pouring all resources into the big tech giants. In fact, according to analysis done by the strategists at Societe Generale SA, the S&P 500 index would have actually seen a decline this year instead of the 8% gain if it excluded stocks surrounding AI. It just goes to show how significant AI has become in driving market performance in 2023. Goldman Sachs also came forward to highlight the immense long-term potential of AI-related shares in supporting US profit margins. They believe that these stocks hold the key to unlocking greater profitability in the future. And recently, we also released a video exploring the top AI stocks to own in 2023. Feel free to check that video out if you're interested in learning more. As we conclude this video, we hope the historical bounce back of tech stocks will benefit you in your decision. Although past performance does not guarantee future returns, the Nasdaq Index's recent performance serves as a powerful reminder that this year could be very profitable for the tech sector. Remember to stay tuned for more thought-provoking discussions on finance, investing, and market trends. Don't forget to like this video, subscribe to our channel, and hit the notification bell so you never miss an update. Until next time, happy investing!